Hello and welcome to Fisher Investments Market Update webinar. We're excited to be talking to you today from both our Camas, Washington and San Mateo, California offices. My name is Liz Dillon and I am a group manager in our research group here in Camas, Washington. I am joined today by Senior Vice President of Research and Investment Policy Committee member Aaron Anderson from San Mateo. Today's webinar addresses the exceptional volatility global markets continue to experience as the world responds to COVID-19. Today, we will discuss how Fisher Investments is analyzing the current pandemic and its potential long-term market impact and actions we may or may not take as a result. So with that, I'd like to hand things over to Senior Vice President of Research and Investment Policy Committee member Aaron Anderson to get things started. Aaron?
Thanks, Liz, and hello again, everyone. I just want to start things off by saying very plainly that COVID-19, the coronavirus, has really been a human tragedy. And I know that it affects all of our lives in different ways, some very directly. But unfortunately, some folks are getting sick. Very unfortunately, some are dying quite clearly. But it affects all of us in indirect ways via restrictions on what we can do, how we can interact with people, certainly our economic and financial lives as well. And with that, I want to talk about the current environment a little bit. So I'm going to jump right into the presentation here, just with a few key takeaways that I want you to understand and things that I want you to get from today's presentation. First, at the top of the list here, I want to make a distinction between COVID-19, the coronavirus itself, and the institutional responses that have been put in place in order to contain it. Because when you think about the recent market volatility, the big drawdown we've seen in global equity markets, it's really that institutional response that's driving that more than the virus itself. Why I say that is because this isn't the first epidemic or pandemic we've ever seen. We've got historical examples of that. But what's really been unprecedented here has been the institutional response efforts to contain that. What I mean by that are travel restrictions, stay-at-home restrictions, shelter in place, closing of businesses and all that. That's really what's having the biggest impact on the market. Now, it might not seem like an important distinction. Of course, one has a lot to do with the other. And I certainly don't mean to imply that these are unwarranted moves. Certainly containing the virus is of utmost importance. But that's really what the market is reacting to. And so as we assess the current environment, while of course we're paying a lot of attention to developments with the virus itself, really what we want to glean on is what does this mean for the restrictions that are in place, the resumption of economic activity, the impact that's going to have on corporations, and then ultimately on stock prices. And as it relates to the economic impact of all of this, what I think is important is to consider that the duration of the economic impact at this point matters a lot more than the magnitude. Everybody knows there's going to be a big economic hit as a result of this. There's going to be a significant contraction. The real question is, how long is it likely to last? If it's a short, steep pullback, but there's a quick recovery afterwards, well, that's an important thing to know. If it's something that's likely to drag on much longer, I think the impact on markets, the impact on how we view your portfolios could very well be quite different. And we'll go through that here later in today's presentation. Another thing that I think is important to point out here is that stocks are discounters of future conditions, meaning that stocks started to move before you saw a lot of these restrictions put in place to the downside, started to move before the worst of the virus seemed to hit. But similarly, stocks are likely to recover before you get all clear signals, before the virus has gone away, before the restrictions have been removed, before you start to see more positivity in economic numbers. Stocks will have started to move well ahead of that. I think that's an important consideration because you see a lot of worst case scenarios out there about how bad this could be, how long it could last. And certainly we hope that the things don't play out quite that way. But regardless, stocks are likely to start pre-pricing a brighter future well before that's apparent to most people. And as we look at the history of markets, utilizing history in a period like this is useful in some ways and not so much in others. A lot of what we're dealing with right now is unprecedented. So some of the historical analysis that we might normally do, I would say really doesn't apply here. But stocks aren't entirely different than they've ever been. What stocks do in terms of their discounting functions, the way that investors tend to react through sentiment and emotion and so forth, all of that is maybe playing out slightly differently this time, but certainly is very applicable today. And what you see historically is when you get big, sharp drops in the market like we've seen so far, they tend to be followed by fairly steep recoveries as well. And I don't mean to imply that the market is going to fully recover with the same pace that it fell, but certainly I think there's the potential that it could recover a lot more quickly than people anticipate. Again, that'll partially be determined by what goes on with the virus and the restrictions and so forth. But I think that's something that a lot of people aren't seeing right now, that there is a potential for a much quicker recovery than people anticipate, certainly a recovery well within the time frame of investors' time horizons who have a meaningfully long time horizon. Now, here's another way to look at the downturn. What we're doing here is comparing this period, the downturn we've seen so far since the market peak this year, to your average correction in your average bear market. And I think there's some important distinctions here. You know, corrections in bear markets tend to play out very differently. This is something that we've talked about for quite a long time, that usually a correction is short, sharp, steep. It comes on very quickly, but then it recovers very quickly. You can see that in that lighter blue line that's on the screen in front of you. Bear markets typically play out very differently. They've got much more of a slow rolling feature. They get off to a slow start. They accelerate once you get towards the end, but of course they're bigger in magnitude. They tend to last longer. And so when you compare this downturn to corrections, to bear markets, I think it's got some characteristics of both. Certainly just from a magnitude standpoint, it's fallen enough to be considered a bear market, and this will undoubtedly be viewed as a bear market as we move on from here. Typically, folks think of a bear market as a drop of 20% or more. And as I pointed out before, we're well beyond that in terms of the peak to trough decline. But it's got some characteristics of a correction as well. The shortness, the sharpness, the steepness of it, the very volatile nature of going from a peak to a bottom is very much correction-like. Now, one of the reasons I think that things have been so volatile and so dramatic here is because there's just so much uncertainty. I think it's very easy to look at the chart I just showed you and say, well, the market is acting very abnormally. It's doing different things than it ever has. And while that's true in terms of the huge daily moves that we're seeing, in terms of the pace of the downturn, I would actually argue that the market is actually acting quite rationally and acting as it should, because we've been hit with unprecedented issues here that are coming at the market very quickly, and the market is digesting that very quickly and pre-pricing it. And what I'm showing you here is just an example of how much uncertainty there is out there. By uncertainty, I mean economic uncertainty. So what I'm showing you with the bars that you see in front of you are forecasts for GDP growth in the US before the worst of the crisis and now in the midst of the COVID crisis. You can see those green bars represent economic expectations in January of this year. And you can see that there was a very tight consensus view on what the economy might do. Those forecasts are very closely clustered. Some were a little bit more optimistic, some a little bit less optimistic, but you see that it's not a very widely spread bell curve here. What the gray bars represent are economic forecasts here just recently. And you can see that there's no consensus at all. The expectations for what this economic impact might look like for 2020 and GDP growth are really all over the place. And I think that's just a function of the fact that these are very uncertain times. We're dealing with very unique information that's coming at us very quickly and changing all the time. And so we think about the market impact of that. One thing that we say all the time, we're not the only ones, a lot of folks say it, is that the stock market hates uncertainty. The stock market likes clarity. But I think another important thing to consider here is that clarity is likely to be coming. Economic data is going to start coming in. More data about the virus is going to be coming in. We've been dealing with this, and markets have been dealing all this in a very short span of time. But as we get more information, what you're likely to see is that these broadly disparate economic views start to focus more in on a consensus view, and just the increasing clarity that comes along with that should in some ways be a good thing for the market. That's not to say that there isn't going to be a lot of economic data that's going to look pretty ugly here, but just getting a firmer sense of what is the economic impact, how long might it last, that increased clarity is an important thing for the stock market. Now, this is just another way to represent how dramatic the economic hit has been. What I'm showing you here are jobless claims, weekly jobless claims here in the US, going all the way back to 1970. And what you can see is towards the end of economic cycle, as you enter a more normal recession, these slowly march up and get to some peak level. What you see on the far right of this chart is just the most recent weekly jobless claims number that was in the neighborhood of 3.3 million claims. And in fact, just here recently, it's not updated on this chart, but we've had a jobless claim number in the following week that was nearly twice that. That really illustrates the fact that the economic hit from this is coming on very quickly in historic ways in terms of the pace of it. But again, what I said before is very important here, that the magnitude is less important than the duration at this point. What really matters at this point isn't how big is the economic contraction, how bad does unemployment get, how many jobs are lost here in the short term. It's how long are those things likely to persist. And that gets me back to a key function of the market. We've said for a long time, this is a point Ken makes all the time, is that stocks discount the future out somewhere between 3 and 30 months into the future. If things are happening, less than 3 months out, that tends to have a smaller impact on the market, a little bit different these days, only because information's been coming to us so quickly. But what I would emphasize here is you think about that time window, about 3 months out to about 30 months, the market recently has been very focused on the short end of that window. It's digesting every new piece of information that we're getting about restrictions, about the virus, about economic impacts, about new vaccines that are being developed or other treatments. All of this is coming us very quickly. But eventually, the market's focus is likely to start to shift out towards a further out time frame. And as you start to look out, past just the next few months, out 6 months from now, out 12 months from now, certainly out 30 months from now, you can envision a brighter future. To my point earlier, the market will start to see that long before it's apparent to most people. And here are just a few things to consider. If you think about that 30-month time frame, what are we likely to see within the next 30 months? Certainly, we could see some bad things here in the very near term. It's likely we're not quite to the peak of the virus spread here in the US, in Europe as well, although we're past it in some parts of the world. Maybe you'll see a resurgence in the next flu season, for instance. So there are things that are shorter term in nature that are coming at us. But within that time frame, we're also likely to see approved vaccines and other treatments. There'll be more natural immunity. Should people be worried about another round of this come the next flu season? We're likely to see a reduction in the many institutional responses that are intended to contain the virus. And you're also likely to see a rebound and resumption of more normal economic activity. There is a light at the end of the tunnel. It's not too far off, and the market's likely to see that well before most folks are. When I'd said at the onset that the market moves ahead of good news and ahead of an all clear signal, this is what I mean. The market will start to pre-price these things well before a lot of it is very apparent. While people are still getting bad news, they're still worried about a lot of what's going on today, the market will start to discount a brighter future. And here's just an illustration of some of that. I won't go into a lot of detail here, but if you think about recent technological advancements, medical advancements, what I'm showing you here is how long it has taken to develop vaccines related to various types of outbreaks historically, whether it's Zika, swine flu, avian flu. For the coronavirus, we were able to develop vaccines much more quickly than in the past. Now, that doesn't mean they're going to be immediately available. We still have to go through a clinical trial process. We still have to do all of that. But this just gives you a sense of how technological and medical advancements, just like all forms of technology, tend to speed these things up. Certainly what we've seen progress technologically has increased our ability to deal with treatments and vaccines for COVID-19, probably in a shorter time frame that we've seen historically. Now, I want you to take this particular slide with a bit of a grain of salt, because I know there are a lot of questions about some of the data that's come out of China, both related to COVID-19, but also just in terms of their economic data and so forth. I would share some of those sentiments, and then it's always important to look a little bit askew at some of the economic and other data that might be coming out of China. But what I think you're seeing here is that there are a lot of ways to see that economic data or economic activity there is already resuming. And so what this shows you is the percent of different provinces that are already back online from an economic standpoint, some more than others, but you can see there has indeed been a resumption of economic activity. We can confirm a lot of this by looking at the Western companies that we deal with, that we invest in, and getting a sense of how they're feeling about their business in China. And that really confirms what you're seeing here, that indeed the economy isn't back all the way back, to be sure, but certainly you've seen the very tight restrictions that were put in place in China. Those have eased quite a bit and allowed businesses to get going again. And if you just put that, again, back in a proper time frame, you say, well, this developed in China sometime late last year. You really started to get word of it and see it gain some momentum in about January of this year. But by the time you get into mid-February or so, You've seen peak number of cases, and here we are. This is as of early March, and economic activity is resuming again. If you start projecting that type of a time frame, maybe not exactly that, maybe a little bit longer, maybe a little bit shorter, who knows? But if you start projecting something like that type of time frame onto Europe, onto the US, maybe in the southern hemisphere, onto some of the bigger economies down there, you can see that there is a confined time frame that we're dealing with here in terms of how long it takes from shutdown to get business activity resuming again. Again, stocks will start to see that before too long. Here's another way to illustrate that discounting mechanism of the stock market and see that the stock market moves before the good news rolls in. What I'm showing you here is the MSCI World Index, but this time during the global financial crisis. And what we've shaded in here is the period that was in recession during the global financial crisis and some of the more significant events along the way. So what I want you to see here is that if you look towards the left-hand side of the chart, you see that the downturn in the global financial crisis started well before the worst of the news came in. Again, this is the discounting mechanism of the market where it moves before the news. And ultimately, you get to the bottom market in March of 2009. The new bull market begins well before the recession is over, well before the housing market starts to recover, well before non-performing loans at banks have peaked, really before economic activity has gotten up and going again, and well before a lot of some of the positive events you see on the right side of the chart there. So the stock market will start to discount a recovery long before it's apparent in the economic or virus or other data out there. And I think that's an important thing to consider, because whatever time frame you have in mind, within that 30-month period that we highlight as being so important to markets, certainly you can see a brighter future within there at some point. And I don't know exactly when, but stocks will start to discount that before it happens. But as we look forward, I think there are a few paths the market can take. One is that this ultimately plays out like a huge correction, that we had the steep downturn, we get a relatively steep recovery. The economic contraction that we're undoubtedly going to see is relatively confined from a time frame standpoint, and you get a quicker economic recovery than most are expecting as well. The middle option there, though, number two, would be more of a traditional bear market. Let's say that these restrictions remain in place for longer, that the economic contraction lasts longer, you get a more traditional recession out of it, and maybe the bottoming period for the market lasts a longer period as well. And then the last scenario there is one where maybe things get materially worse from here, that maybe these restrictions stay in place a very long time, much longer than the market is expecting. Maybe the economic hit is much bigger and for longer, and maybe there's a lot more downside ahead for the market. But I would say, just given the volatility, the drop, the uncertainty that we've seen already, that's certainly not our highest probability outcome here, but one we want to consider.